Hello and welcome everyone again. I'm glad you could make it join us today. We have another exciting show lined up for you, so we're again happy you could be here. So, first thing that everyone should remember to do is go over to our website, breakthrough.reipodcast.ca. There you can download all of the past shows that we've done over the past. I think Sandy mentioned that it was upwards of 7 years now. But yeah, so that's it's been a crazy ride. We got lots of stuff there, and we try our best to keep everything relevant, no matter when you listen to it. So hopefully you'll find some nuggets in some of those older shows, and you can also pick up our free gift, right, Sandy?
The ultimate strategy for building wealth through real estate. You can pick that up on our website. Go download it. You'll also get it on our email list, of course. I never miss out on a show through that. And that way, if your podcast platform's down or your phone's not working or something weird, you can always pick up the email somehow and figure out how to listen to our show. And you'll also hear about all of our property tours, seminars, anything else like that we got going on. So jump on over there so you don't miss a beat.
Yeah, I'm doing property tours every other week now. So if you sign up for that, you should be able to get on the list for all those property tours. And unfortunately, we're doing them virtually. So, it's a little bit easier, I guess. It's not as much of a commitment, but at the same time, it loses some of its feel. But you get the idea. You'll get a little bit of the education. You'll see what some of the other investors are doing in the areas that we invest in.
Hey, you could go there from Vancouver, from Halifax,
Yeah,
get in on it. So that I think it's actually pretty cool. You can jump on in there in ways that you couldn't before.
It's true. And of course, everyone should go over to iTunes and leave us a rating and review. It really helps us out, guys, and I appreciate everyone that's done that so far. So it's definitely something that Sandy and I appreciate a lot, and we read a lot of the reviews and stuff like that. We're not doing that today, but we do appreciate them all. So thank you. What's new with you, Sandy?
Well, we're what Q4 almost here, 2020. We're down the home stretch of the year, having fun with finalizing some goals and whatnot, and just getting excited to kind of plan out the next year, which might be a little different, hopefully, than 2020 has been all over the place, obviously. So, we're going to talk a bit about that today on the financing side and what that looked like, but just buying more properties, kind of, and trying to secure great deals and helping others do the same. Kind of just managing all that and what that looked like this year. But yeah, I don't know. We're just the same old, really, buying some stuff and selling some stuff.
Yeah. I guess it's interesting how it becomes the same old for us, which is great. It's great, but I think a lot of people, maybe someone that's listening to this now, maybe one day they'll find themselves saying the same thing because of the show, and learn a little bit today and be able to keep on moving and keep on accelerating and building up their portfolios the way that they want to, and not being held back like a lot of people are. So that's really one of the main goals of this show and what we always try to do. And I think for sure our guest today is going to be able to help them do that, because even though we'll get to, we got a really cool intro for you.
Sure.
But before we get into that, I just think that as much as you can help us on the financing side, you're also able to really inspire and motivate and show people the best way to go down these investment paths. So I think we're going to have a really interesting conversation today. So welcome, Dion.
Thank you very much, Rob. Hey, Sandy.
Welcome. Hey, yeah, all the way. We're back over 100 episodes ago. I think we last.
Is that right? Yeah, I remember I was on episode 23, so I was like one of the first ones.
We've actually been on almost all or most of them, actually, in one way, but you haven't been with us live for a while.
That's true. But congratulations on the success of both of you. Sandy, I just see everybody in the McKay network, like you're just growing by like crazy. So good on you.
Thanks. And yeah, we've done some stuff with you, and you're doing some awesome stuff. I love the virtual now virtual. What I missed that.
Webinars, yeah.
I'm blanking on the name of the Path to the Good Life.
All right. Yeah.
Love seeing those. So that's been cool. The virtual setup for that has got to be almost.
Yeah, I can tell you, I was always resistant to go online with seminars because I feel, and I still feel that there's some importance in physically going out there and meeting people. And that'll still be part of what I will do going forward. But the world hasn't allowed us to do that. And it's kind of forced me to go online, like many people. And I've been very pleasantly surprised that people are still engaged, still very interested, and turning out in the numbers of hundreds of people attending these webinars at any given time. Because it seems like there's a lot of people out there who are interested in real estate, but they're just maybe a little bit scared, and they just need a little bit of extra knowledge, which gives them confidence, which moves them to action. So that's the whole purpose of the webinars that we present. And I mentioned to you guys earlier, I've got another one coming up on Tuesday, October 6th. So hopefully we can share that info with your audience.
Yeah,
absolutely. And I love that you got you're smarter than a lot of our guests, I guess. You got your email right there in your name there.
I figured it'd be easier.
Smarter than us too. We don't have ours on there either. So there you go.
I know, it's genius.
Wow. Smartest guy ever to come on the podcast.
Well, the smartest guy in this room right now for this minute.
That's right.
Moniker. All right. So we got an intro for you. So Sandy, you want to?
There's a whole bunch of awards and stuff. I can get through a couple of them. I know.
Okay.
I know. There's lots of credibility here to live up to for Dion here. So he's a multi-award winning mortgage professional, 15 years experience, property and finance world, involved in over $500 million of real estate transactions. He is top 75 brokers for several years in all of Canada. Formerly a financial advisor, so assisting people with wealth creation through property. I've done various amount of guest speaking gigs all across Canada, Canadian real estate boards, to real estate agents, real estate investors. Spoken at Harvard University. Owns property in 3 different continents, actually, or 3 different countries at least: Canada, US, and Australia. Is on a mission to show regular people how the right real estate portfolio can be a path to true wealth. And most importantly, father of two young daughters. And today he's excited, I guess, to be here, share with us about the current state of the market, financing world, and talk a little bit about, I think, what holds people back and how we can help maybe even the non-investors find a way to buy 1, 2, 3 properties and really change their life. So pumped up to have you here again, Dion, and welcome again.
Thank you, Sandy.
Yeah, Dion, thanks for being here. As you mentioned before, you were our guest back on episode 23. That was a great show. Enjoyed it a lot. But for the newer listeners who didn't happen to hear that, maybe you could tell us a little bit about how you got interested in real estate.
Sure. Okay. So for those of you who don't know, my accent is from Australia because that's where I grew up. And if we go way back, in Australia, I graduated with a degree in international business. That's one of those ones back there. And with that, I went and lived and worked in Japan for a couple of years. And, I was working for Canon Cameras in their international division. And I speak Japanese as part of what I studied. So that was fun. But while I was in Japan, I bought my first house back in Australia. And then when I came back to Australia, I had saved very hard for the 4 years I worked in Japan. I came back with $20,000, which I thought was a lot of money for a 20-something-year-old. And then, but the house I had purchased had increased in value by $80,000 over the same period of time. And so at that point in my life, I kind of stopped and I had this pause and I said, hang on, I worked my butt off for 4 years. I saved 20 grand. And this one piece of real estate increased in value by 80 grand, 4 times more. So I said to myself, look, I have to go and explore this thing of real estate. This is just too interesting to ignore. And that's really when I dove into this idea of wealth creation outside of just the 9 to 5. Like, how is it that we can get ahead without just trying to save whatever's left over at the end of the month? And so that really sort of got me into real estate. In Australia, I held my realtor's license, as well as I became a financial planner. And very few people in those two worlds mix those two things together. But I was very lucky to work for a smaller sort of boutique financial planning firm, which basically focused on showing regular families that, yeah, you can invest in stocks and bonds and mutual funds, but there's also this thing called real estate. And if you wanted to look at real estate and look at the returns, the leverage possible, I'm probably preaching to the converted crowd that you're listening to here, but the returns in real estate are in most cases 4 to 5 times greater just because of leverage. So the understanding of leverage was key. And I'm very happy I got exposed to that idea when I was in my 20s. And since then, I've just been continuing to build my own wealth in real estate and basically show anybody who's willing to listen that maybe real estate is something that they should really consider. So my personal mission is to just take regular families who are just trying to do a little bit better and show them why real estate is something that they should include even as part of their portfolio. Oh, Rob's on mute.
Rob's on mute. Yeah.
Do that all the time.
Okay.
Try to stay quiet while you're talking, and then it ends up staying on mute. But Dion, you're a very successful speaker and an agent with Butler Mortgage.
That's right. Yeah.
So what is the profile of the people that are coming into real estate now?
Yeah, so it's mixed, but I can tell you that it's mostly people who have been investing in their traditional paths for a while. They have their RSPs, they have their RESPs for their children, mutual funds. They're probably in their 40s or 50s, and they've done everything that they were told to do, right? They're by their financial planners, by their parents, by their neighbors, they're doing their traditional path. But they've been investing long enough to know that if what they continue to do is what they've only ever done, they're not going to reach the sort of financial freedom goals that they have for their future, right? It's people who have been sort of disappointed and finally come to the realization that mutual funds may have a place in the world, but I need to do more. I need to jump onto a different trajectory so that instead of ending up with $500,000 at the time of retirement, they want to aim for 2 to 3 million. And I see a lot of people come to me in their 40s and 50s. They see the finish line. It's 15 years away, 20 years away, and they do the math and they go, you know what I'm doing is not enough. And so they come into real estate because they've heard that it's something that they should explore. Maybe they've listened to some podcasts or things like this, and they've just got a little bit of information to say, you know what, I want to start building this here. And I know a lot of people listening here to this podcast may own, 10 properties or plus. But the majority of our clients come to us owning 0 or maybe 1 or 2 that they've and they don't know how they got there. And then they want to know, okay, if I want to make this a real thing, how do I get an extra couple of $1 million worth of real estate today, hold on to it, manage it for the next 20 years, and then, come out the other side more successful. And yeah, most of them are I'll give you an example. I've got a client who came to me a couple of years ago. He's a janitor for the Toronto District School Board, and he married a teacher at the Toronto District School Board, right? So regular family. They came to me, they understood that they paid off their house, which was an achievement. And but they knew that even that was not going to be enough. So we explained what we could do for them. And in a matter of 3 years, they purchased 6 properties. You don't have to purchase 6. They chose to purchase 6. And now they have a portfolio of around $4 million. And they're happy. They know they can just manage that for the next 20 years. When they retire, they're likely going to have a portfolio with a net value of 7 million plus.
Right. So it's worth the tenants and toilets headache is what you're saying. Because that's the biggest thing that a lot of people that's the biggest issue that people can't seem to get over. Is that whole...
Rob, you hit that right on the head there, right? People see the numbers. They go, oh yeah, real estate, the numbers, yep, the numbers win because we can get an 80% loan. You can't get an 80% loan to buy mutual funds. Not that I'm aware of. And I've asked that question in hundreds of rooms. Nobody's ever said, yes, Dion, you can get a loan secured against the mutual funds to buy mutual funds, okay? I've never come across that, right? But yes, we all know all day, every day, as long as you're qualified, you get an 80% loan to buy a property. Now, sorry, I'm off track here. What did you ask there, Rob?
I was just saying that a lot of people's major issue is
the property management. Yeah. So the thing that stops people, it's not the numbers. The numbers don't lie. It's this idea that they're going to become slumlords. They're going to be dealing with people who are going to wreck their house, and they don't want their evenings and weekends consumed by dealing with property issues, but more so interpersonal challenges with people, right? And I want to tell everybody that if I had to deal with those things, I would not be a property investor, right? The way I deal with those things is I choose to outsource those problems. Now, you may choose to self-manage your property, and that's totally fine. But if what is stopping you from getting into real estate and jumping from 5% returns to 25% returns is the idea that you have to deal with people, then let me tell you this. In the world, there exist these things called professional property managers. And these professional property managers, and for those of you who don't know, they will advertise your property, collect all the applications, help you choose the best one, do the background checks, the credit checks, and all of that, tenant the property, collect the rent, and deal with all the maintenance. So if what is stopping you getting into real estate is the idea that you have to deal with tenants and deal with property, let me tell you that if you are willing to pay to get to your 25% returns, then you don't have to deal with those things.
And I would even go one step further. It's like, you know what? Just deal with the pain. Just deal with the pain for the first couple. What's it going to hurt you? Look at the returns you're talking about here. If that's not worth a little bit of work, then, I don't know what is, right? I mean, most people go to work and they break their back all day and they'll make that 20 grand a year, like you were talking about before. So, I mean, I would even say that, first of all, I agree with you 100%. I don't want to manage them either.
Yeah.
Right. So, but I have. And what I'm saying is that was worth it at the time.
Yeah.
So I would encourage anybody out there. So look, now instead of a 25% return, maybe it's a 20% return, or maybe it's
exactly.
Typical property management fees are about 8 to 10%. Let's say.
That's right.
Okay. Sorry. So now it's 15% return. That's still better than you're going to get anywhere else.
Yes.
But not even talking about the appreciation.
Yeah. And that's the other point. Property investment, guys, it doesn't have to be the best investment in the world, whatever you buy. Here's the goal. The goal is it simply has to do better than what you're currently doing, right? And what most Canadians are currently doing in mutual funds is around 5% a year. So if a piece of real estate can return you 6, then that is better. But most pieces of real estate that I own, if I look back historically, especially over the last 10 years, have made me 40% per year. And I'm sure you guys are 40, 50% per year, depending on the market you're in and the returns you're in. So when I say to people 25% return, 20% return is real, I can say that from a position of confidence, right?
Yeah, and especially, I mean, over the last couple of years, no one's got a crystal ball, and we said that right from the beginning. When every time that I decided to make a move and purchase something, I didn't know what was going to happen next year or the next year. I just decided, hey, this one looks great on paper. I'm going to take that chance and I'm going to do it. But yeah, like it's been a real ride the past couple of years and the returns have been insane. So we don't have a crystal ball, but it could continue that way.
Well, that's why you can talk about that's the easiest. It's such an easy way to look at it, is that you're getting whatever you're getting elsewhere, 5, 6, 7, maybe on really someone doing pretty well. It just needs to be better, right? It doesn't need to be a home run, doesn't need to be a grand slam deal. Those are great if you find them. Maybe if you're active in there, you might find one, every couple of years or something. But a decent average property really doesn't even, and I know you could touch on this, really doesn't even need a cash flow necessarily month to month, depending on your situation. Obviously cash flow is great, but you're already spending it on something else, right? So just reposition that money, and the difference is astronomical over a 10, 15-year period, right?
Yeah, I mean the simplest example I have is a lot of responsible parents out there would be getting their children RESP, Education Savings Plan, and it's an easy one to compare, right? So if you have kids, or people with kids, or anybody listening has grandkids, you probably are very familiar with an RESP. And I'll tell you the math around that, and we'll compare it to real estate. So the way an RESP works is you can contribute around $200 a month into that vehicle, and you do that for 20 years, right? And at the end of 20 years, you've invested around 48 grand of your own money. The government will match you to around $7,200. So you get like 55 grand invested for your child. And, on all the scales I've ever seen, you probably end up with somewhere between 80 to 100. So let's just say you'll end up with 100 grand to give your child at the end of 20 years. So that is what most responsible Canadian parents are doing for their children today. Okay. And I want to remind you, it's going to cost them $200 per month to do that. Right. Alternatively, or maybe in addition to this, look at the purchase of an investment property at, say, 500 grand, right? And assuming a certain level of growth, and the number I use is 5%. Again, like you guys say, there's no guarantees, but that's the historical average, 5% growth. At the end of 20 years, the value of the assets increased and the debt load has reduced, right? So you basically, you buy this property for 500, you take on a total debt of 500 because you borrow everything, including the down payment. But over time, what happens is this gap happens, right? Property price increases, debt load gets paid down. And the spread, the differential over 20 years is not 100 grand, it's $1.1 million. So we're talking a factor of 11 times more, chasing and assuming a 5% growth in the piece of real estate, right? Now, if that also costs you $200 a month in negative cash flow, then let's compare the apples to the apples. RESP, $200 a month. Property, negative cash flow, $200 a month. The difference is 11 times. So I always joke, if you love your kids, buy them a house. If you don't really like them, just get them an RESP and looks like you're doing something.
That's a huge difference, like massive difference, isn't it? Like that's a game changer for their life and their kids' life and generations, probably, potentially.
Yeah, and again, it's just knowledge, right? This stuff isn't taught at school. All of us have gone out and had to piece it together ourselves. We had to be seeking this information, right? And
that are on top of what you were saying, Dion, is that most of the time, I would say, I agree with your comparison. I understand why you did it, but most of the time, I would say there's not a property that I have steered one of my investor clients into that doesn't have positive cash flow.
Mm-hmm.
At least probably around $200 a month.
Yeah.
So, I mean, if you look at it that way.
If you look at it that way, then it costs you nothing, whereas the RESP, the RESP will cost you $200 a month in cash flow, right? Mm-hmm. So in your example, Rob, that household, that family would be better off by $400 a month over 20 years. So the cool thing about that is they can continue to live their life, go on holidays, go to restaurants, let their kids play hockey, even though it's expensive, right? And still grow this wealth by a factor of 11 times versus their next door neighbor who's doing the traditional thing, right?
And so I think obviously the objection maybe to that comment would go down the lines of, well, where do they get the money in the first place to buy that property, right? And so, that's probably one of the maybe misconceptions or one of the challenges up front, right, to trigger that scenario to start happening. So what do you do in that scenario? What can you do to help people like that are just having trouble finding that initial, obviously a $500,000 asset, you're going to need 100 to start,
okay,
right?
So let's break that down. And I will tell you that a lot of people, maybe people listening to this may know, but may not know, a lot of people come to me and they say, Dion, I live in an $800,000 house, but I got a $400,000 mortgage. There is no way, based on the fact that I have this $400,000 debt, there's no way that a bank's going to lend me more money to buy more property, right? And we have to break this down for people and explain to them how this all works, right? So I'll just run with this example, if that works for you guys. So the first thing you need to know is that if you have equity and you have good income, then in most cases, we are able to, in that scenario there, borrow more money to buy more property. And so I'll give you some quick numbers. If a property is worth $800,000, if you live in a house today that's worth $800,000, then a bank will lend you 80% of that number, which is $640. Okay. If you've got a mortgage of $400, it means you've got capacity of an extra $240 to tap into. A bank won't lend you 100% of your property, they'll lend you 80%. So in this example, you got a $400K mortgage, you can also get a $240K line of credit. Okay, so let's just assume that's doable. And of course, for that to be doable, you have to earn a certain level of income, because we can't just borrow money because of the equity. We have to prove that we could repay that monthly payment. And the quick math on that is, as long as your household income is around 120 grand, and that's usually achievable for a double income family, then everything I just discussed there is possible. Okay, so let's assume that you go get this line of credit on your first home, or access some equity. So that's component number one: access your down payment. Then step number two is to go and find a property. And let's say we're using a $500,000 purchase price. Okay, so at $500,000, we're looking at a required down payment of 20%. So I want to get clear on this point. Every week I have people call me, say, Dion, I've been told 30%, 35% down required for a purchase on a rental property. And almost always, these people have spoken to somebody at their bank branch who doesn't deal in an investment property every day, right? And they've just read the textbook, and they'll deal with 20 mortgage inquiries this week, but maybe one of them was for investment property. And so they just give the textbook answer: it's 35% you're going to need. But the reality is, as long as you're dealing with in particular a broker who has access to multiple lenders, you'll quickly learn that 20% down is normal. It is standard. It is not outside of the box. It's well and truly within the guidelines. It's just that a lot of people, even people who work at branches, aren't aware of this, right? So 20% down is doable. We're buying for 500. We need 100 grand down, right? Let's keep in mind too, there's closing costs and land transfer tax. You need 110 ballpark. So we've got that because we got the line of credit for 240. So we've got more than enough for the down payment. But now the question is, well, Dion, we've got to buy this property. We've got the down payment, but now we have to borrow another $400,000. How is this possible? I've already got 400 grand plus a line of credit on my house. How is this possible? And it's possible because all lenders recognize rental income from the property you're about to buy. And so if we can demonstrate that the property you're buying is going to rent for, let's just call it $2,500, and the cost of monthly running of the property is $2,000, then in that type of scenario, we very well may be able to demonstrate that that property is a self-sustaining business unit. Monthly expense is lower than monthly revenue, and as such, we can go off and buy that. That's what the bank looks at. And this is how you see people buy multiple properties. It's not because they make millions of dollars on their salary. It's because they buy the right type of property where we can demonstrate to the bank that the expense is lower than the revenue. And we duplicate, triplicate, and so on and so on. And so for this example, just to round it off, this family in this example that I've given you has 240 grand line of credit. They have enough for the down payment on at least two of these types of properties. And so many people come to us saying, Dion, there's no way I'm going to be able to borrow more money to buy property. And that very same year, they own two rental properties in addition to their principal residence.
Mm-hmm. I was just going to say that. I was super pumped for them when you said the 240. I was like, they can buy two.
Yeah.
Man, they're lined up. I'm really happy for these people.
And I'll tell you, there's so many people who come to us that way, Rob. And I know we all love talking about these massive portfolios of 10 or 20 properties. But I will tell you that just one extra property owned for a period of 20 years has the ability to impact your personal net worth by more than $1 million. So don't get in your mind that, I can't get into property because I can't buy 10. Just get one. See how that works out. And when it works out and the sky doesn't fall in, you'll buy more. But just start with the one and then go from there.
Well, on that note, it's sort of twofold. There's two things that I think that you got to take into account there for that person in the example that was coming to you. One is really lack of knowledge. And the other is a mindset that there's no way that I can do something like that. Right. Mm-hmm. So on that note, let's discuss the big things that you see stop people from actually getting started. There's other things, right?
For sure. I mean, we all make up these stories in our mind about, giving ourselves reasons as to why we can't do something, right? Now, what I've found is that there's about 5 or 6 things that people really need to get their head around in order for them to feel a certain level of confidence. So I know that I don't do anything in my life unless I feel confident in what I'm doing. and confidence leads to action. So if action is the goal, we need confidence to take action. Well, how do we get the confidence? It just comes down to this one thing called knowledge, right? Mm-hmm. If we are ignorant, or we feel that we don't have the enough information or knowledge about a particular thing, then it is on us to get the knowledge, to then get the confidence to take action, right? So to that end, there's a couple of things that you need to know about this. So in terms of real estate, number one, I like to start with the idea of goals, right? Because a lot of people just want to make money. And I want to let you know, most people don't get into real estate just because, they like the idea of owning property. It's because of some other bigger goal. And I think that if people are not clear on why the hell they're doing this, right, then they're not going to take action, right? And this comes down to sort of this idea of your future self, right? People who invest for 5 or 10 or 20 years from now have a very clear image of who they are 5 or 10 or 20 years from now. And it's kind of hard for a lot of people to do this. And in fact, I'll go sidetrack here for a second, but you mentioned earlier I spoke at Harvard University last year, and it wasn't actually on the topic of investment. It was on the topic of delayed gratification and your best future self. So let me tell you about this interesting study. They put some people into an fMRI machine, and they asked them 3 questions. The first question was, imagine yourself. And so a part of their brain lit up. The next question was, imagine a stranger. And in that case, a different part of their brain lit up. Okay, they're imagining 2 different things. The third question was, imagine your future self. And in the majority of people, the stranger part of their brain lit up. So what this means is that when people think about themselves in the future, they can't really connect it to who they are today. And if you don't have that connection and you're asking yourself to do things to help your future self, but that future self was a stranger, then why would you do that? Like, Rob, why would you get out of bed at 5 o'clock in the morning and go to the gym if it was only helping a stranger, right? People who do that because they have a connection between who they are now and who they are in the future, right? So I find that people really need to get clear on their goals about their future and link who they are now to their future. So it's a bit sidetracked, but I want you to know that's a huge thing. I think the majority of the people that you guys work with, you're working with people who are very clear on who they're going to be in their future 10, 20 years from now and what path they need to get on. So that's a big one. So getting clear on those goals. And then once you're clear on the goals, here's what you need to know in real estate. You need to know who you can trust, where to buy, what to buy, and property management around it. And also, potentially, if you don't have the cash or the borrowing capacity, how to engage partners in order to do these things. So, I know you guys talk a lot about this stuff, but if you like, we can expand on it. Or
yeah, absolutely. I mean, I think it's all gonna turn into one big ball of info that people can grab onto, right? So
yeah, sure. So, let's start with the right people, right? As I said to you, this stuff's not taught in school. And so if you want to get into real estate, it's really up to you to find the right people who, and you know this, in our industry, there are a lot of people who are very good salespeople, and they'll win multiple awards for their transaction volume. But those same people are not necessarily investors themselves or understand investment property. And so the challenging thing for the regular consumer out there is, okay, if I want to get into investment property, who do I trust? How do I find realtors, mortgage brokers, insurance professionals, property managers who know how to deal with investors? And so the one thing you need to know is that if you find one or two key people, a good realtor, a good mortgage broker, they in turn should be able to introduce you to the other people in the network that you're going to need. So what's important is find the right person. How do you find them? Well, there's 2 realtors on this podcast who you could probably reach out to. But yeah, find a key person that you can trust, and then look, Google them, find the references, make sure that they're legit and they know investment property. So that's, who to work with. In terms of where to buy, okay, where's better, guys? Hamilton or Oshawa? I'm going to step back and let you fight.
Well, I mean, obviously, I would say that, you know, you got to look at your numbers, and if you're satisfied with the numbers that I would say the important thing is, like you said, a goal, right? So if your goal is a certain return, it doesn't matter if it's in Hamilton or Oshawa or Peterborough or Guelph or wherever the hell it might be. It only matters that you're able to get that return buying that property. And if you can do that, it doesn't matter where it is. That's my opinion.
Well, especially if you're property management and everything in place and leveraging it in that sense, you can buy property anywhere and not ever really needed to go there, as long as you're trusting in the right people, obviously, is the starting point there for sure. I think, I'm sure Rob and I were saying, we get people from all over the place, right? They don't necessarily live in the same province or country even, right?
Yeah.
So it's Dion's, you got property in Australia. Yeah. That's not exactly around the corner. Right. How the heck can you do that? Well, it's property management, the right trust and the right people. And just, it does help if it's around the corner. It probably makes it a little easier to take action, I would say. But ultimately, that's really
I have a couple of properties that are a 7-minute drive from where I live. I can honestly say I haven't driven past them in a year. I just know that they're there.
For those first timers, they really do like to be able to drive by and go, look, that's my house. Seeing a picture is one thing, but I do think that for most first timers, there is, like, as much as people like to say, I do this for my bigger goal, I think that there is something in that, the pride of ownership, really, of an asset like that you can actually walk up and touch. It isn't an RESP or something that's really just exists on paper.
Yeah, I think, when it comes to finances and motivation, I think there's two key components. One is cash flow, the ability to know that there's money on a monthly basis. And the other thing is just this sense of security, right? This knowledge that, let's say we go back to this $500,000 piece of real estate. If the property market increases in value by 5% that year, then the property's gone from 500 to 525 grand. That's just on appreciation, right? And that's, if you break that down monthly, that's over $2,000 a month. That family's personal net worth is increasing at a rate of $2,000 a month based on just appreciation. Now throw into that principal pay down, the fact that every month you're collecting rent and paying down your mortgage, it's actually closer to 35, 36 grand a year. So it's, in most cases, the acquisition of one piece of real estate gives you $3 grand a month. $3 grand a month in personal net worth gained every month. If you get 3 properties, guys, you're looking at $9 grand a month. It's as simple as that.
And I don't want to go off on a super huge tangent here, but a lot of times, like, we're looking at something where we can force that appreciation right off the start to begin with as well. So, and then we're also increasing our rental income, which goes hand in hand with that. So, I mean, I can honestly say that in most cases, anything that I purchased, let's say 4 to 5 years ago, is literally doubled in value in the market that we've been in over that past time. So
it's interesting to say that, Rob, because that has happened. When we make plans for our clients, we make it a 15-year timeline, right? So yes, property has doubled in 5 years, especially if you're doing some forced appreciation. It's doubling in 5 years. But if we look at that 5% number that I was referring to earlier, 5% means that property prices, and your listeners should look up, if they don't know it, should look up the rule of 72, which explains how long it takes for an asset to double in value depending on the rate of return. At 5%, assets double in 14.4 years. So we'll call it 15. So at 5%, I always say, look, if you've got a 15-year horizon and you're willing to hang in there for that period of time on one piece of real estate, and it's worth $500K today, it should very well be worth $1 million in 15 years, right? So the numbers are kind of mind-blowing, but I think that it's also a very forgiving asset too. We can go through some ups and downs. As long as you can keep that tenant in there and the tenant pays, then you can ride those things out. Yeah, so look, we were up on the checklist there of where to buy. So I think where to buy is really about where to buy and what to buy kind of go together, right? Because, could you buy a downtown duplex in Toronto that's going to cash flow day one? Maybe. In fact, I had a client just do that, but it was like a needle in a haystack, right? Whereas in the outer suburbs where you guys work, you can find these properties well, you still have to work hard, but there are more of them. You still have to pick the best of the bunch, though.
Mm-hmm.
Have you been finding it a little harder in today's market?
Well, I mean, it seems to get increasingly harder, but it's also a fact of getting anchored in something that you were seeing before, right? So, a couple of years ago, so we recently started going up to the Peterborough market, and let's just use this for an example. About 3 years ago, you could buy a regular bungalow for about $320,000. There's a no-brainer all day long. It still is, but now we're probably looking at about a $420,000 purchase price instead, just in the past 3 years.
3 years, yeah.
So those same people that you're working with, or even somebody newer coming in, it's really hard, even from my own perspective, to understand that. Not to understand it, but I'm still wanting to find that same property that I found 3 years ago for these people, right? Because I'm always trying to work as hard as I can to get some in the best returns and the best possible property that they can get into. So I think that is one of the keys that we also need to talk about as well. Is it's the best time to buy property was 20 years ago. This next best time is today.
That's right.
There's never going to be a better time than today.
Well, you get fixated on that, right? You get used to that return. It's just like everything's changing in the world all the time, right? You got to be able to pivot a little bit, be able to adjust your criteria a little bit with the times. But the rental rates have gone up like crazy too, right? So it's not like maybe sometimes depending where you're, sometimes at the same level, sometimes not. But it's definitely. In our market here, it's been tougher to find that. You can still find a single family home that cash flows positive month to month. It's more challenging. You're into some not as great of an area as you would have been 10 years ago. 10 years ago, you could have bought in like a premium area with a cash flowed single family home with a positive cash flow, which is incredible. You should have bought. Everyone should have bought more homes 10 years ago. It's the same thing. It's going to be the same truth 10 years from now, most likely, right? So. You got to take action now. There's no real better time other than the past, which we can't change.
Well, I mean, I'm stealing this quote from Mark Loeffler. I believe I'm paraphrasing it somewhat, but if I look back, I might have paid a little bit too much for some of the properties I bought, maybe a little bit. But I swear, if we examine those properties and where it's got me to today, I look like a genius.
Exactly.
Well, I know for sure 2017, we bought a bunch in the early spring 2017, right? Hottest market up until probably today. You could easily look back a year after that and say, oh, we overpaid for sure for those. I'm pretty happy we bought them because you have properties there that I'd rather have done that than take a year off and not have gotten into the market, right? Getting in the market's the biggest thing and staying in there.
Yeah, agreed. And guys, like so many times I talk to people and they've been waiting for the right time, right? They're waiting for, in particular, in recent history, they're waiting for 2009 to happen again, right? And so they've literally been sitting on the sidelines for 10 years. And in this last 10 years, while they're trying to time the market, if they had just got in 2010, then they would literally have $500,000, $1 million in extra net worth today. And again, my goal is to just give people enough knowledge, enough confidence to get off the sideline and get on the playing field, right? Just get on the playing field. Just do what you can with the information you have, trusting in a team of people that allows you to be on the playing field and ride it for the next 10 years. Don't wait another 10 years and then try then, right? You got to start now.
So you mentioned, like we talked about the power of just having one extra income property, right? So in your experience, let's take that average household that you were talking about before.
Sure.
What is their limit? Like if we're talking about a $500,000 purchase price, let's say, for each property, we're going to use the exact same examples that you've done. What
Yep.
can these people actually do?
Well, in that example, these people are just really limited to their down payment capacity, right? People tend to run out of down payment before they run out of the ability to qualify for more property. Okay, so let's go back to this example. This family had access to 240 grand. To buy one piece of real estate, they need 100 grand down, plus closing costs, 110. So they could do this 2 times. They would have deployed 220,000 of their 240,000 capacity, right? And so now they're out of the ability to raise capital. So what will happen in this scenario is that either we have to wait for several years for equity to build, at which time we can refinance, access more equity, and then go again. And there's nothing wrong with that. For other people who get into it and they get the understanding behind this, what they will do is they'll now take their knowledge and their recent experience in real estate and start talking to their network of people, right? Because as much as 1 year ago, 2 years ago, these people didn't own any property. Well, now they own 2. And in their circle of friends, they're likely the only family who owns an investment property, especially 2 properties. And so what happens is their circle of friends now turn to them as the expert, right? Because an expert is somebody who knows a little bit more than me. They're a couple of steps ahead of me. And these people will often partner with their friends who are a little bit scared to get into real estate and go, look, I don't know about who to trust or where to buy or what to buy, how to run the numbers, how to qualify for a mortgage or any of that. If you're willing to help me, then we'll go that way. So these people who are now tapped out of their own working capital now joint venture with partners. And I've seen that being the next logical step for a lot of people who hit that capacity in terms of, down payment wall.
Mm-hmm. What about partnering with someone who's buying their first property? Because that question comes up a lot. How do you deal with something like that? Can it be looked at as a rental property or not?
Yeah, so I'm actually right now helping 2 brothers. One brother is established, a little bit older, got a family, and his brother, the younger brother, is buying his first home. So they've got together, and the brother could go buy a condo or a small townhouse or whatever, but they've decided that together, the older brother is going to help the younger brother buy a duplex type property. And so by doing that way, and both chipping in for the down payment, mortgage qualifying, whatever, they're both going to benefit from the upside of buying a better property that has the ability to cash flow, right? So there's lots of different ways to sort of partner up with those types of scenarios. But yeah, I've seen that multiple times over the years.
Yeah, because that could be somebody's challenge listening, right? It's like not like they have something to tap into, but they want to get into something like this. And yeah, I've heard of that lots of times, especially, here's a pretty popular one, like people going to college. They say, why am I going to pay somebody else to live in their house? Let's buy a house. I'll rent it to my friends and we'll all live there. And afterwards we can keep it as a student rental. That's a pretty popular choice as well.
Yeah, I see lots of parents doing that for their children. They're looking at, $7,000 a year in outlay for housing or whatever it is. They're like, well, why don't we flip that? Make some money. They're at school for 3 years, and at the end of 3 years, they sell the property.
Yeah.
That's what we found here in Hampton. A lot of is it's hard to compete actually with those people as a regular investor now, because we're always looking for the nice deals, and the student rentals are tough because it's the average family's coming in and paying what they're probably worth anyways, but the market's gone up quite a bit because you don't necessarily need to feel like you're cash flowing like crazy with your
it's a different
your own
right?
Yeah, your own child's living there, managing it and stuff, right? You were going to be paying out of pocket anyways or something.
Exactly.
So it's interesting how that's affected the market. I think it's a great strategy. Why not do that?
Yep.
It's affected it for the rest of us a little bit, but that's okay.
That's all right. I think there's enough to go around.
So there's lots to go around, even though the inventory is inventory is very tight as always at pretty much anywhere in Canada, probably anywhere in North America, but there's still lots to go around. There still is. There's room in the market for sure. So, Dion, can you tell us about the new program you got going here, the investment property Springboard? What's that all about?
Yeah, sure. So, for many years I've been teaching mostly at real estate boards, real estate coaching companies, mortgage coaching companies. I've been teaching real estate professionals on the idea of property investment. But in more recent years, clients have always said to me, Dion, I wish my family knew about this info. I wish my friends knew more about this. And, these are coming from people who, like many listeners here, probably have been really seeking this info for 5 years plus. So they know real estate. They understand it inside and out. But there's a lot of people out there who just need the basic info in order to give them that confidence to take action in real estate. So I decided this year that I would create a course to help those people who are sitting on the sidelines get onto the playing field. I'm like, this is my mission, just to get more people into ownership of real estate, even if it's just one. And so this year, I created this course specifically for brand new investors who own zero investment property, or investors who own like 1 or 2 properties and they just don't know how they got there maybe, and they want to know how to take their best next steps so that they can move forward into real estate a bit more purposefully, a bit more maybe precisely, buying the right type of properties. In particular, I get a lot of people come to me and they've bought pre-construction properties. Years ago, they were fortunate that they bought in a rising market and then the rents kind of covered. But they understand now that that's really not investing, it's speculating, right? It's gambling. And so I'm trying to take those people and then help them grow in the right direction. So basically, this is the course that I've created. It's called the Investment Property Springboard. It's a 5-week online course where we cover those exact topics that we just discussed here in terms of, getting your goal setting right, the right people, where and what to buy, how to run the numbers, and so how to develop joint venture partnerships. So that's what I've been doing for the last little while. And I'm happy to say that, the first participants in the course have come out. One of them had been an investor 20 years, but felt stuck. And as soon as the course was completed, she went out and bought 2 properties, the right type of properties, because she knew what she had to do, right? Another guy, a younger guy, personal trainer, just starting out, felt stuck because he was out of working capital. And he finally had the confidence now to go and talk to his family about where to buy and what to buy. He now became the expert, and he's gone and done 2 joint ventures in the weeks since the completion of the course. So I'm really quite proud of the fact that this course is having the impact that I desired. And that course is available for anybody who's interested. My email address, as you know, is in the box there under my name, and you can reach out to me there.
Awesome. Right. So info@dionbag.com is the easy way to figure it out for our listeners.
Yeah, exactly. And the link will be in the show notes as always, but info@dionbag.com.
Right.
Great. Okay. So we spoke of the current state of the market a little bit. Let's talk about what you think is in store for the future as far as financing and lending is concerned.
Give me 1 second. I'm going to grab something. So this is a magazine. Probably people know this magazine, Toronto Life magazine.
Oh, yes, you got the magazine. I was hoping you would talk on this one. Perfect.
Yeah. So when this came out, I think I got 10 of them in the corner there. So basically, this came out in 2016, 17. 2016. It was their 50-year anniversary, right? And it was kind of cool because what it did is it looked back 50 years to see the state of the world 50 years ago. And then it projected forwards 50 years based on the last 50, what's going to happen in the next 50, right? And so, without having to read the whole thing, here's the story. In 50 years from now, and this is not for our children, but probably for our grandchildren, how the impact will be. The average house in Toronto is based on history, should be going at around $4.4 million, right? So if that's the reality for the future, you would hope that wages would be increasing to the same level, right? The problem is that with automation and other factors, and based on historical wage growth, the income 50 years from now is, let me just make sure I get this right. Yeah, I'm going to show you this number. This is the projected income of a regular Canadian 50 years from now. $56,000, right? Now, even if they're wrong by a factor of 2, let's say it should be 100 grand. How does a person who makes 100 grand buy a house worth 4.4 million? It doesn't work, right? And so here's what I'm going to tell you, what you already know. It's that this middle class that most people have grown up with, whereby, you know, if you work hard, you send your kids to school, they get a good job, then your kids can live the life that you lived. Mm-hmm. Your white picket fence in the suburbs, vacations to Florida and Disneyland, right? That type of future that people just have assumed would be possible for their children, I don't think is a reality. I think that we people who are of age and have the ability to go and build wealth today, we have this obligation, right? It's no longer enough for me to get my kids a good education and hope they get a good job. It's not enough. If they're going to be entering a world where, you know, in 15 years from now, the average house price, it won't be 4 million, but it'll likely be 2 million, right? If they're going to be entering that world, then I actually have to take action today to create wealth for them. And if you want an example of this, just jump on an airplane when you can and fly to New York City. Walk around there and ask yourself this question: how in the world do people afford these properties? And the answer is the people who own those properties didn't buy it with their own money. They bought it with their family's money. And Toronto is heading in that direction. Now, yeah, we can talk about the outer suburbs, but trust me when I say they're going to be impacted, maybe not to the same dollar value, but maybe by the same percentage value. They're starting from a lower price point, so they'll end up at a slightly lower price point. But if things go at the continued pace that they are going, and keep in mind what this fueled by, it's fueled by in particular population growth. You know, we happen to live in a country where it's very attractive to upwardly mobile immigrants. If you're an upwardly mobile immigrant right now and you're looking at the state of the world and you want to move your family to a country, then the country you want to go to is a country that has stable government, good healthcare, good education, good infrastructure. We happen to be that country. That's going to continue, right? Our country is positioned as a very attractive country for immigrants. So I'm not trying to be a doomsdayer here, guys, but I'm trying to read the numbers, read the facts, and say, if this is what I believe is going to happen, and it's probably going to happen, then we have to take action, not just for ourselves, but for the next generations. So intergenerational wealth is part of what we discuss a lot with our clients, because yes, we need to look after ourselves, but we're going to have to help our kids.
Yeah, I don't think all of our kids can be famous YouTubers, unfortunately. That I know they all want to be, but I don't necessarily think that that's a sustainable future either here.
Yeah.
It's doomsday in a way, but it's also it's almost kind of exciting, I guess, if you're the ones that if you jump on things now, there's still lots of time to take action and make it happen, and be on the positive side of that, right? And be the one enjoying the fruits of that, of owning some property in somewhat near the suburbs here in GTA or somewhere of a market. Otherwise, you're going to end up in Nunavut or something, somewhere out there that's maybe not where you want to be.
Yeah, and I think we have to take that action.
No offense to Nunavut, but there's not many people there.
But yeah, you don't have to agree with what's happening, but you have to acknowledge what's happening. And what's happening is housing's become a commodity. It's not just a place to live. That's where people hold their wealth, right? And the future is going to be this future of landlords and tenants. And you have to decide what your children are going to be. Are they going to be property owners or are they going to be tenants? Mm-hmm. And it's kind of on you. If you're there in your 30s, 40s, 50s, trying to provide for your family, in my opinion, you need to buy some property.
And let's talk real quickly about the difference between the opportunities that we have here And I know you were saying it's very tough to cash flow in like, downtown Toronto or whatever, but the majority of us are on the outskirts and we're looking
Sure.
for something where we can get positive cash flow, and that's still possible. And I know you haven't probably been to Australia in quite some time, or at least you haven't like lived there in quite some
Yeah.
time. I remember listening to a podcast out of Australia, and just the idea behind the way that they look at investing in property is significantly different than the way that we look at it here. There's no such thing as positive cash flow.
Correct.
Australian.
It's extremely hard.
So, I mean, I think that the opportunity we have here is incredible, as well as being in, like you said, all of those things that we have going for us as far as infrastructure and stable markets go and all that kind of stuff. That, we've got a benefit that not everyone has.
Yeah, I mean, landing here in Canada 11 years ago, I was coming out of Australia where interest rates were at 7% and you could not find positive cash flow. And here, interest rates at that time were about 3% and positive cash flow was everywhere. And I just felt like I'd been running uphill in Australia for the last, 10 years. And I'm running on the flat. I'm like, wow, this country has such opportunity. And the thing is, the people didn't know this, right? Because they don't know what they don't know. And so again, I made this my mission to try and get it out there and say, people, you don't know how good you have it here. You can buy a house where the monthly rent is greater than the monthly expense, right? Whereas people in Australia are happy to take a $500 negative cash flow and just hope that the taxation benefits and capital gains works out at the end of 10 or 20 years, right? It's a very different approach. You don't have to go that extreme here. And yeah, there's a world of opportunity still available for people who are willing to take action.
Well, Dion, thanks so much for coming out and sharing all of this. Greatly appreciated. I think that this is one of the, the most inspiring and information. So,
okay, great. Actually, well, before I forget, I wanted to mention, I got this event on October 6th at 7:30 p.m. So if you want to drop the link in the description, for whoever's interested, I basically go through the sequence of what people are doing with their money, compare it visually to what they could be doing, and answer the big 3 questions that most people have, which is, how do I get debt-free, pay for my kids' education, and build wealth for retirement? That's the 3 questions that I've been talking about for 10 years, right? But now we're doing it in webinar format. And whoever's interested, feel free to tune into the Zoom link, which we'll provide to you.
I would say go one step farther. Invite your friends or family, because it's pretty impactful, and it would be a great little gift to give someone to go check that out, because it might impact their lives in a massive way. So,
or if you've got that joint venture partner who's just not getting it,
that's exactly right.
That too.
Maybe they're right on the fence and they just need someone to give them a little more insight. This is perfect for something like that. So we're going to have that link in the show notes. There's going to be plenty of time for you guys to get ahead of this and plan it out. I think when this comes out, even on the audio format, there's still going to be some time for people to jump on there. So definitely go over, check out the link. It's in the show notes. And thanks, Dion. Man, that was awesome.
Thank you, guys.
So
thanks, Dion.
What's the best way to get a hold of you? Is it this info at Dion?
Look, just look me up. I'm pretty much the only Dion Begg in the world, I think. So just see my name, Google me, you'll find me. I'm on Facebook. But yeah, check out the website, dionbegg.com or mortgagesbydion.com.
Awesome. Sandy, how can people get in touch with you?
Sandy at McKayRealtyNetwork.com would be the easiest way.
And people can reach me at rob@mrbreakthrough.ca. Well, thanks everybody for coming out again. Really appreciate it. And we'll see you next time.
Bye.